Good evening. This is Ken at Tortoise Capital with a re-recording of a conversation with a day trader about his research into power laws and the excellent results he's getting from day trading, and show how that resonates with the work that we've been doing with the Dragon and the River. So, Trader G, who has asked for anonymity, which I'm going to respect here, authored a 5-part series of articles for the Van Tharp Institute, February and March of 2018, and he showed how he had done a personal application of a lot of the tortoise principles with the use of statistics, signal to noise, and some of the Tharp Institute's work on position sizing, and developed a RLCO flow style of trading in broad liquid indices during the day, especially with the use of the Russell 2000. Original recording audio was a little messed up, so I'm going to redo that here. Thank you for your patience. So this is a summary of some notes that he had sent me over Christmas. And he has done a deep dive into power laws as they affect his Russell 2000 trading-based system. We had been sharing some insights about the academic literature, which demonstrate that there are power laws applying to 1-minute level across many symbols and indices. And so what we mean by power law distribution is simply a distribution or a movement in price that doesn't diminish. If you think of like a bullet, you get that initial explosion, it gets as strong as it's going to be, and then with the interaction with the environment, it starts to slow down. In a power law distribution, it's more like a avalanche or a collapsing sandcastle, where you have a small amount of energy at first, and then when that starts to collapse, that triggers a wider range of collapses. And so in power law distributions, like a floodplain as well, initial energy gets multiplied because of a reinforcing feedback loop. And so the observation is that many of the patterns in 1-minute charts follow this kind of distribution. You don't get a one pop and then diminish, but you get a pop that leads to more momentum and then building energy. And then as the higher time frames begin to engage, what started off as a small move gathers its own momentum, and then like an avalanche, essentially has an unpredictable outcome in terms of length and duration and volume of the trade. And so a lot of academic literature has identified these kinds of characteristics, particularly on the rise since of the increase in algorithmic trading, which is designed to pick up on certain patterns of momentum in many cases and then reinforce it early in the curve. You start stacking up a lot of these little systems, a little move can trigger a larger move, and it often happens by surprise because there's no direct consciousness involved in here. It's simply pattern recognition, and there's no way of knowing what algorithms are out there and how they're going to be firing and are they prepared to trade. So you get these often surprise moves that look like they start off simply and easily, but then build into some very powerful intraday moves, which then diminish when all that algorithmic buying or selling disappears, and you revert back to something like longer-term fair value. So our RLCO-based patterns and the MACD histogram patterns do a pretty good job of mapping out the dimensions of these moves and finding out the sizes of previous moves in order to calibrate our estimates of what could potentially become a big move. It doesn't predict when they're going to happen, but we can start posturing ourselves for certain moves, which can lead to those kinds of power law moves. It doesn't predict when; it just predicts the conditions in which big moves are more likely. So Trader G, in order to better understand what he sees with every trading day, developed a way to capture and crunch the 1-minute bars on the Russell. And it's finally clear to him where his position win rates are coming from, not from a skill in predicting, but rather from the effect of power laws, which is an inevitable consequence of algorithmic trading. And so the model that he uses for the Russell 2000 may not work so well for other indices, and that's principally due to intrinsic noise and poor price behaviors in the other indexes. Whereas the price behaviors on the Russell are far better suited for this kind of anticipatory trading. He's also been doing a deep dive into systems thinking, and we've been writing back and forth about nonlinear emergent properties that will help explain and analyze the effect of things like the feedback loops, power laws, that compound to his favor in his day trading system. And so his basic engagement with that systems thinking, what he calls that swim, has really helped his trading a lot. And that motivates me to set a target for producing an updated systems thinking home study workshop this first quarter of this year. It's been something I've been meaning to do, and it has to do more with educating about these kinds of concepts rather than any particular system. In that workshop, I'll be developing concept presentations and then show how they connect to trading in order to help with our education. Okay, so let me go a little deeper into Trader G's research. So the data he was sharing with me represents some 4-day samples of 1-minute bars over some recent periods of fairly volatile trading. And he's developed some statistics, and let's go through those. So the percent WR is the percentage of green bars when the bar closes above the dragon, and the percentage of red bars that follow when the bar closes below the dragon. It really gets to the idea of length of move or length of streak. And so when the dragon closes above, when the candle closes above the dragon on that particular day, 72% of the bars were green until you got a red bar. Excuse me, I should say that. All right. So of all the bars from the time it closed above to the time it closed below, I should say it that way, 72% were green. And then 75% were red once it closed below the dragon. So what you get is a periodic move that lasts. So if this is a simplified version of that price pattern, if you remember, the dragon, which I'm showing as the orange line here, lags price a little bit. So I'm showing 1-minute bars in black notionally. The blue line, as you know, represents our 10-period moving regression line, so that acts as a proxy for price. And the dragon then is a 10-period Bollinger Band with a plus or minus 0.5. So it is a smoothed version, a volatility-adjusted version of a 10-period simple moving average. So you get price moves first, followed quickly by the blue, and then the dragon lags slightly. And so the significant move occurs when price and or that blue 10-period regression line crosses from one side of the dragon to the other. And then what follows is a period of movement of on the far side of the dragon until that move runs out of gas and then rolls back this way. So this is an idealized, almost a sine wave looking waveform. Trader G's observation is that when the price is on that side of the dragon, 3/4 of these bars are red. So not only are you getting a directional move, but the movement inside the bars is directional. And then once it crosses over, you're getting 3/4 of the time green bars, so rising until it runs out this way. And so that's interesting, and it also aligns pretty closely with signals that we look for, like a 1, 2, 3 entry on a reversal here, 1, 2, 3, or the RLxD when the regression line crosses the dragon. That's the third criteria in the owl pattern. It's also the entry signal when we have a continuation play, like a pocket entry. And so that has always held important significance for us. And so being able to trade from RLxD to RLxD, there's a certain statistical edge for you there because of the persistence of these kinds of probabilities that you see. And again, these are for 1 minute bars, and these are for the Russell 2000, which has a orderly type of price movement. So that's what we mean by percent WR. RRR, a reward to risk ratio, is the weighted average of the sizes of all the favorable bars compared to the unfavorable bars closing outside the dragon. So an unfavorable bar that closed outside the dragon would sort of be that exit when price crosses over the dragon. And so you can see you're getting 2 to 1 in terms of not only the directionality but the size of those moves. So there's a certain statistical edge involved in paying attention to that crossover point. PF is simply the profit factor, which is the RRR times the percentage, and that gives you this number. Odds is the approximation of the odds of success if you enter on each bar that closes outside the dragon, and so he's getting very effective, favorable odds. So you're getting a high win rate, and you're getting favorable odds on when the move goes in your direction. So that's pretty helpful. One of the reasons I believe that the Russell is so smooth is because you don't have noise coming from the individual components in a significant way that's disrupting that signal. You're getting really the pure movement of trader philosophy or psychology, if I can say it that way. Whereas in a large index like the Dow 30, those individual components are so large that they can be moving the index around, so you're not getting a pure index momentum base, but you're also having to aggregate some sectors and large individual components, which can affect that orderly move. So that's why they tend to be a little noisier. But the general principle would be the same, that we are very interested in these kinds of moves. Now, where the RLCO and MACD histogram advantage comes from is that we are very interested in the size and direction of the previous move, and that the greater that this move is away from what had been the Bollinger Band mean in the middle of the river, the 30-period moving average, the greater this excursion, the greater the likelihood that this is an anomalous distortion, and you're going to get one of two things: either a reversion back towards that mean, or this wasn't an anomaly at all, but was really the beginning of what's a large and powerful move in that direction. So when you have an anomalous move like this, significantly pulling away from, let's say, the RL270 or the 30-period Bollinger Band, you know that that symbol is in play, and that either you're going to get a large reaction move or a continuation pattern. So that's one of the principles of the OWL pattern, is to take advantage of exactly those kinds of characteristics. That's just some quick insight. This is an example of the Tortoise research community of practice working together to help develop ideas, share them, and to show the way one trader is going about applying ideas to his own situation and psychology, and crafting his own a system that fits him, and then being willing to share that with others, those insights, to help us in our collaborative journey. So, thanks for your kind attention, and we will see you in the chat room.